Imagine being able to unlock the doors to your dream home, your dream car, or even your dream business. What if I told you that a secret code can make all these dreams a reality? This code isn't hidden in a treasure chest or guarded by a dragon. It's right there in your credit score. Today, we're diving into the 6 key factors that affect this powerful number. Buckle up, because understanding these factors could be the key to unlocking your dreams. Number 1. Payment history. Payment history is the most critical factor in evaluating your creditworthiness. It's not just a suggestion, but an absolute necessity to make timely payments. Your payment history reflects your responsibility and reliability in meeting your financial obligations. Conversely, missed or late payments can severely impact your credit score. They signal potential financial irresponsibility to lenders and can lead to additional consequences such as late fees, increased interest rates, and the loss of promotional rates. Serious delinquencies like defaults or bankruptcies have even more long-lasting effects, making securing future credit with favorable terms harder. To maintain a strong payment history, it's essential to establish a budget, set up reminders or automatic payments, and seek professional advice during financial hardships. Always remember that paying your bills on time is not just a suggestion, it's an absolute necessity. Your creditworthiness and financial future depend on it. By prioritizing your payments, staying on top of due dates, and taking proactive steps to resolve any financial difficulties, you'll pave the way to a healthier credit score and better economic opportunities. Remember that building and maintaining a clean payments track record is an ongoing process, requiring discipline and responsible financial management. But the rewards are worth it, as a solid payment history opens doors to improved creditworthiness and financial stability. Number 2. Credit utilization. Credit utilization is crucial in credit scoring, reflecting how responsibly you manage your available credit. This ratio is calculated by dividing your total credit card balances by your total credit limits and multiplying the result by 100. Maintaining a low credit utilization ratio, ideally below 30%, is highly recommended to ensure a healthy credit score. When your credit utilization is high, it can be perceived as a sign of potential financial instability, which can negatively impact your creditworthiness. Lenders may view high credit utilization as indicating that you rely too heavily on credit and may have difficulty managing your debts. To maintain a healthy credit utilization ratio, monitoring your credit card balances regularly and aiming to pay them off in full each month is essential. By paying off your balances, you keep your credit utilization low and demonstrate responsible credit management. Additionally, you can request credit limit increases from your card issuers, which can help improve your credit utilization ratio. Another strategy is to spread your expenses across multiple credit cards rather than maxing out a single card. By being mindful of your credit utilization and keeping it within recommended limits, you'll demonstrate responsible credit management and maintain a healthier credit score. Remember, a low credit utilization ratio is a powerful indicator of your financial stability, so keep it low and watch your credit score soar. Number 3. Length of credit history. Your credit history provides a snapshot of your borrowing and repayment behavior over time, and a more extended credit history can work in your favor when building a good credit score. Lenders and credit bureaus consider the length of your credit history to indicate your financial stability and ability to manage credits responsibly. It's not just about having a credit card or a loan. It's about demonstrating a track record of responsible borrowing and repayment spanning an extended period. Building a more extended credit history requires patience and strategic planning. One essential tip is to keep your oldest accounts open, even if you don't actively use them. These accounts contribute to the overall length of your credit history and show creditors you have a well-established financial track record. If you're new to credit or have a limited credit history, establish a solid foundation with 1 or 2 credit accounts and use them responsibly. Over time, your credit history will naturally grow. And as long as you continue to make timely payments and manage your credit wisely, you'll be on your way to building a solid credit score. Number 4. Credit mix. Having a diverse credit mix is crucial for a healthy credit score. Your credit mix refers to your various credit accounts, such as credit cards, loans, mortgages, and retail accounts. Lenders consider this factor because it demonstrates your ability to handle different types of credits responsibly. A diverse credit mix benefits you in multiple ways. It shows lenders that you can effectively manage various financial obligations, instilling confidence and potentially boosting your credit score. Additionally, it highlights your financial maturity and responsible borrowing behavior, which is particularly important for larger loans like mortgages. However, it's essential to approach credit mix diversification strategically. Opening multiple new accounts too quickly can negatively impact your credit score. It's about finding the right balance and managing your credit mix effectively. If you currently have a limited credit mix, gradually introduce new types of credit into your profile. Number 5. New credit applications. Credit scores are influenced not only by your past financial behavior, but also by your present actions. One significant factor that affects your credit score is the frequency of new credit applications. Applying for credit may seem harmless, but it can significantly impact your credit worthiness. Frequent credit applications raise concerns among lenders and credit bureaus due to the generation of hard inquiries on your credit report. These inquiries indicate that you seek additional credit and can be perceived as a potential risk. Multiple hard questions within a short period can temporarily lower your credit score and signal financial instability. To minimize the negative impact on your credit score, it's important to approach new credit applications strategically. Be selective in applying for credit and thoroughly research the terms and conditions. Spacing out credit applications over time and evaluating your credit needs and eligibility before proceeding can help manage the impact. Additionally, carefully consider pre-approved credit offers and assess the potential consequences on your credit score before accepting them. Remember, not all credit inquiries are created equal. Soft inquiries, such as checking your credit score or background checks by creditors without explicit consent, do not impact your credit score. You can monitor your credit without worrying about negative consequences. By managing new credit applications wisely, you can avoid unnecessary inquiries and mitigate potential adverse effects on your credit score. Being mindful of when and why you seek new credit contributes to maintaining a healthy credit profile. Number 6. Negative marks. Negative marks on your credit report, such as collections, charge-offs, and foreclosures, profoundly impact your credit score. They signal to lenders that you've struggled to meet your financial obligations, making it challenging to secure future loans or credit cards. Even if approved, you may face higher interest rates and less favorable terms. But don't lose hope. You can take action to mitigate the effects of negative marks. Start by contacting the creditors associated with the negative marks and discussing your situation. Explore options like payment plans or settlement arrangements. Many creditors are willing to negotiate and find mutually beneficial solutions. Keep documentation of any agreements reached, as proactive communication is vital. Paying off or settling your debts is crucial for improving your credit score. Consider seeking professional advice from credit counseling agencies or credit repair services, as they can guide you through the process. Remember, negative marks are not permanent. With consistent effort and responsible financial behavior, you can rebuild your credit over time and create a brighter financial future. And that's a wrap on the 6 key factors that affect your credit score. I hope you found this information valuable and that it helps you on your journey to financial freedom. If you enjoyed this video, don't forget to give it a thumbs up and share it with your friends, who might also find it helpful. Now, understanding your credit score is just one piece of the puzzle. If you want to save money, check out our previous video, 9 ways to reduce your monthly utility bills. I've linked it in the description below and at the end of this video. Remember, every little bit of saving contributes to your financial health, so don't miss out on those tips. If you haven't already, please hit that subscribe button and the notification bell so you won't miss our future videos packed with practical financial advice. Thank you for watching, and as always, keep striving for financial success. See you in the following video.